I would say the debt capital markets are very healthy, and REITs have been able to access those really with very tight spreads, although obviously the benchmark rates are pretty high right now. So it's great to see that the REITs are healthy from a loan-to-value perspective. They're able to access the debt markets. Equity seems to be coming later as we go through the cycle.
So, Stephen, as we round out 2025 and look to 2026, how would you describe the capital markets backdrop for REITs, and how are they responding?
Sure. It's been an interesting year. I would say the equity markets remain a little challenged as the REITs trade at a discount to NAV. Obviously, that's sector specific, but we're seeing that across the board for the most part, with a few exceptions. I would say the debt capital markets are very healthy, and REITs have been able to access those really with very tight spreads, although obviously the benchmark rates are pretty high right now. So it's great to see that the REITs are healthy from a loan-to-value perspective. They're able to access the debt markets. Equity seems to be coming later as we go through the cycle.
And we've seen a fair amount of M&A activity in 2025. Do you expect more of the same in 2026? And are certain REIT sectors more likely to be active than others?
We did see a fair amount of privatizations and some M&A here in 2025. I would say going forward, we would expect, at least in conversations I'm having, more M&A and more privatizations as well. As the equity pricing remains challenging, private market values are higher than the public market values today. And so you'll see some of these privatizations like Blackstone's doing with Alexander & Baldwin, you'll see that continue. What we expect to see is probably some consolidation in some sectors. And you asked which sectors we expect to see. I'll say some in lodging, in industrial, I'd say a little bit in multifamily, and then in the specialty sectors. I won't say specific names because there's very few of those companies in each of those, but those are conversations that are happening in real time.
And what are some of the other main themes relating to REITs and capital markets that you expect to be watching closely in the coming year?
I think REIT executives and REITs have done a really good job of recycling capital, of doing a pretty strong job of refinancing their debt and making sure they're delivering a risk-adjusted return to their investors here, tax advantaged as well. What I'd expect to see is a fair bit of consolidation and privatization, as we just discussed. But I also expect to see a little help from the Fed, even though they just lowered a quarter point the Fed funds rate, and we're kind of taking a wait-and-see approach for the next year. We've heard from a lot of our clients that labor markets have cooled, and candidly, the multifamily REITs in real-time data, as well as SFR data, that housing inflation has cooled down as well. So we would think that the Fed's going to take a little bit more of a dovish approach in lowering rates over the next intermediate to long term, which will be very helpful for cost of capital for REITs. And as those REITs are able to get a smaller discount to NAV and hopefully a premium to NAV, they'll be back in the equity markets hopefully here and making acquisitions and continuing to grow.